Craig Erlam of OANDA joins us right now on the show with his thoughts. Craig, good having you. Thanks much for joining in. Apologies to keep you waiting, but the addresses of Prime Minister Modi and President Donald Trump were on. However, nothing seems to be soothing the frayed nerves of the markets. If anything, they've gotten worse. What's your sense? Can this deepen? Can the correction deepen, Craig?
Absolutely. I think we have to remember coronavirus has dominated as far as markets are concerned for most of the last month. Yes, we did see it record highs at one point, but that was when it felt like we were seeing the light at the end of the tunnel. We were seeing a deceleration in new cases across China, and there was an idea that we were finally starting to turn a corner. Well, that's dramatically changed now, because while the number of cases are still decelerating in China, elsewhere they're accelerating. We've seen deaths now in South Korea, in Iran, in Italy. And now we're starting to see the fears starting to heighten once again, because we're moving away from the known area, which is where we know roughly where this is headed, back into unknown again. We saw how rapidly this escalated a month ago in China, and now we're facing a prospect that we could be looking at the same across different continents. So this is quite worrying for investors, and I think that's why we're seeing markets move deep into negative territory at the start of the week.
Do you feel like the equity markets so far have not factored in the full impact, the full blow of what coronavirus could actually turn out to be if it exceeds, the first quarter, quarter four of this fiscal, which it most likely will, and therefore a more amplified sell-off is something that we could anticipate?
So I think this is a symptom of where markets are right now. Markets are in a position whereby investors are looking for buy the dip opportunities at every opportunity. So when we start to see any signs that we were seeing improvement here on the coronavirus side, investors got straight back in. The fears disappeared and it became an opportunity game again. And therefore, I think there's a little bit of complacency that's maybe set in. Maybe people are getting burned a little bit now because they were maybe just a little bit too ahead of the game. It's paid off in the past, so who are we to comment? But what we're seeing now, obviously, is the negative side of that. What happens when you don't know everything that's happening and when things are getting much worse. So I do think they have overlooked a lot of the downside, because actually this sell-off that we saw in the equity markets started before we started to see the cases popping up in Italy and South Korea and other countries. It actually started a week ago when Apple reported that their first quarter earnings are going to be negatively impacted across two fronts, one across production and another across sales, obviously with China being an enormous smartphone market. Since then we've had Adidas, Puma and many others warning, and I think over the coming weeks many more companies are going to join in that chorus, and we're going to see a lot more negativity as a result. The fact that we've also now had, this has been compounded by these new cases, the death toll rising in other countries. I think that just further worsens and further makes investors more sensitive to the negative news which we are seeing.
You feel then that you could see further recalibration of global growth rates? China obviously now has been factored in at 3% for the quarter, probably 5% for the year, but global growth as such could suffer too on the back of this. Do you feel that there could be a revaluation of that?
Absolutely. The IMF said over the weekend that they think that the coronavirus is going to shave 0.1% off global growth at this moment in time. But obviously now the situation is deteriorating. I'm sure that will change. And we also now have to reevaluate exactly what type of recovery we're going to see. We very much focused on a V-shaped recovery at this moment in time. We bottom and then we start to move back to the levels we were at before. We may have to accept that this may be more of a U-shaped recovery, and that things will have to gradually improve, because improvements in some areas will include deterioration in other places, but also factories getting back online, getting back up to full capacity, and ultimately the consumers are a massive part of this. How quick are they going to be to jump back on those flights, to go back into congested areas, to hit the stores? All of these things have to now be factored in as part of the recovery, because ultimately the worse that this situation gets, the more apprehensive consumers are going to be, and the more apprehensive consumers are going to be, the longer this recovery is going to take. Don't get me wrong, I think in the next few months we are going to see a full recovery, and this will be more of a blip in the data, and it becomes a question of how much of a bump will we see in the second half of the year to accommodate the downside in the first half of the year, both from a consumer perspective in terms of they have more cash in their pockets, but also from a fiscal perspective, government's trying to boost the economy after a downturn in the first half. But at the moment, what we're really focused on is just how bad things are going to get in the meantime.
Craig, equities globally, as you know, are seeing a sharp correction. Dow futures currently are showing a downtick of about nearly 500 points. I'm asking these questions because it looks like a risk-off trade now. The yellow metal gold is trading at its life high levels. Do you think this sort of scenario will continue in the near future? Risk-off trade will continue and the focus will shift to safe havens like gold?
Yeah, I mean, we've certainly seen that over the course of the last week. With regards to something like gold, we were seeing a massive barrier around $1,600. So when we had the geopolitical tensions at the start of this year between the US and Iran, we spiked briefly above here, but it pulled immediately back. Then when the coronavirus kicked off and we saw some risk aversion in the markets, we fell short around 1590, and then we pulled back once again. Once we finally broke through 1600, the fears really set in. It's really propelled itself higher, hitting close to 1680 already, and nothing seems to be holding it back. As you say, we've got the Dow that's looking 500 points down already today. We've got Italy, which is 4% off. We've seen, obviously, like say South Korea, which has lost a few percent overnight, and the broader markets as well, all in negative territory. I don't see that turning in the next 24 hours or so. I think this could be potentially a bit of a downside week, and that's only going to further support gold. The next test obviously is $1,700, but it wouldn't surprise me if we break through that with relative ease, even if we do see a little bit of profit taken in the run up to that, because, like I say, as the numbers continue to get worse over the next few days, hopefully they don't, but if they do, then I think that will show itself in risk-averse equity markets, and therefore supporting safe havens like gold.
Craig, just one last question from my side. With fears now escalating, of course, to other countries, be it South Korea or Italy, how do you see the fund flows then going ahead shaping up vis-a-vis emerging markets and the developed markets?
Yeah, I mean, like I say, I think we're just going to see plenty more risk aversion, and at the moment risk aversion is leading itself to a stronger US dollar because obviously that the return that you get on US Treasuries at this moment right now is very appealing in times of risk aversion. So the US dollar is obviously performing very well. The dollar index around 100 at this point, trading at 3-year highs. That's always going to put downward pressure on the emerging market currencies, and again then that just starts to heighten fears around who's most at risk. But I think many people still do view this as a short to maybe medium-term issue as far as the economy is concerned, and the markets tend to take a much shorter view on it than that. All we need to, like say, is signs of improvement, and I think the markets will start to bounce back. So I don't see it as a major risk factor as far as emerging markets are concerned in the medium term. It just means that at this moment in time, things like the dollar are going to be well supported, and certain currencies are going to come under quite a bit of pressure.
Craig, we leave it at that. Thank you so much for joining us this afternoon.